On the sell side, I just thought I'd put up a sample of transactions that we've most recently completed. These would be over the last 12 to 18 months. Since inception, our firm has closed about over 80 deals, with totaling over 4.5 billion of combined enterprise value. So you can see here, like, we've worked with businesses across a diverse range of industries, purchasers that spanned from local to multinational players. A typical client for us is a privately held businesses, first, second, sometimes even third generation of ownership that's considering a full or maybe a partial exit, or maybe looking for a financial partner to help them grow. And so the goal of today, as Natasha mentioned, is I'm going to talk about the more, I guess, traditional exit options, selling to strategic or private equity, and then Joanna will talk about some other options. So to set the stage, I think it's important that we talk through the definitions. So first, strategic buyers. Strategic buyers are operating companies. So they will be your competitors, maybe companies in adjacent, business lines or industries, or maybe upstream and downstream from your business, like a supplier. Strategic companies are motivated to grow, to gain market share, acquire a new capability, or maybe enter a new market. For strategic purchasers, transactions are about fit. They're acquiring companies because they want to integrate them into their existing operating business. Remember, they are operators. And so fit and synergies are going to be a huge focus here. Certain business risks like maybe certain customer concentration or having lack of maybe second gen or second tier management or a succession plan, they matter, but they might matter less to this purchaser group because, of course, these strategic operators already have management teams in place, and they're already familiar with the industry and operations. On the other end of the spectrum, we have private equity. These are our financial buyers. Private equity acquires companies as investments. So in a traditional sense, private equity has raised institutional capital and they need to deploy that capital to generate returns. So for a private equity group, their goal is always to work towards an exit. Acquire a company, usually using leverage to minimize their initial cash investment or equity check, and help grow that company in order to then sell it in the future and make a return on that investment. So what does private equity focus on? Returns, growth, KPIs, strategic plans, monitoring against your strategic plans. And most importantly, like private equity, they're not operators. So they require sophisticated and robust management teams to be in place to run these companies. And what that means as a seller is that it's more than likely, or many circumstances, you need to keep some skin in the game, which means you're going to retain some level of minority ownership. We'll go into that later. Private equity, they follow what we call a buy and build strategy. So what that means is private equity will often acquire a anchor business. This is their platform investment, and then use that anchor business to bolt on similar businesses that help them grow and scale to maximize value on a future exit. So if you are that company who could be an anchor investment, what does that mean? It means private equity is going to be excited. They're going to want you, but they're going to want you to stay. There's probably going to be a longer time horizon and commitment on a seller's part and on management to use that platform investment to lead future acquisitions. In contrast, an add-on investment, these can be smaller in size, or there's a wider range of size. They definitely need a strong second layer of management, but maybe they don't need a seller to stay on for as long because you can leverage off of the management team of the anchor investment. And the reason I raise this is because, owners that often thought that their company was too small for private equity might actually be a good add-on target at the right time. Lastly, I wanted to point out kind of the middle ground between these two, which is private equity-backed strategics. It's a mouthful. These are operating companies, but their ownership is controlled by private equity. So what that means is they're like a strategic because their owners and operators in the business. But they have a very strong acquisition strategy and backing from private equity to grow. Lastly, because this is a very relevant buyer group in Canada, I want to raise the idea of search funds. So, by definition, search funds are individuals or maybe small groups of individuals that have raised some capital and they want to buy a business. But they want to buy a business that they're going to work in and run. It's kind of like entrepreneurship via acquisition. Um, and so they're not raising institutional capital, but they're putting their money to work by acquiring a business and running it day to day. So the plus is if if this is a company, if you're selling a company, you might not need to be involved post-close because the search fund will have a management team in place. That being said, they tend to be more on the value buyer's side. And 5 years ago, we really didn't see much in terms of search funds, but in Canada today, there's, I think, like almost 250 search funds. So they're an active buyer group. An important thing that I wanted to highlight here is kind of how the buyer universe has shifted over time. So this is a summary of our transaction stats since inception of our firm in 2010. So what we can see here is that there's been a shift from what was once a very heavy focus on strategic purchasers, those are the operators at 59% of deals, to where we sit today at about 40% over the last 3 years. So why does this matter? It should tell you that private equity and private equity-backed strategics are becoming the most and more active participants in terms of activity. There is diversity in this pool of buyers in terms of what they're looking for. And like private equity, we say like private equity transacts in good times and in bad. They're always looking to invest. So the takeaway here is if you're not taking steps to make your business potentially saleable to this purchaser group, private equity and private equity-backed strategics, you are missing out on a large portion of the market in terms of buyers. So what we've done here is we've mapped out the various buyer groups across typical priorities of sellers. Oh, sorry. So these are factors that can often be trade-offs. Like you can't get them all. So if maximizing value is of most importance to you, that in itself is diametrically opposed to confidentiality. Like if you want to maximize your value, you need to create some competitive tension. You're going to have to go out to multiple parties to get multiple parties kind of bidding to purchase your company. And the more parties you go to, obviously that's in contrast to wanting to maintain confidentiality. Big picture here, strategics are likely, in general, going to pay the highest headline price, and that's because they're paying for synergies. They're going to deliver the management resources and capabilities, which limits you as a seller's future involvement, but they're going to want full control. While private equity can preserve more of that confidentiality, right? Like they're not competitors to you. You'll be able to maintain some autonomy over operations, but private equity needs a strong management team. Sellers are often needed to retain equity in the business. And that's why we call this a second payday. Because as a seller, you will carry some equity in the business post-transaction and then get to realize on that investment, on that carried equity when the private equity eventually sells the company. So this can create a lot of upside through a second payday, but you have a longer involvement and time horizon. For family offices, these typically have longer hold periods, which is important when you're considering your involvement, and potentially less aggressive pricing than strategics and traditional private equity. And then, as I mentioned before, search funds, they're going to bring kind of management capabilities. They want to run a business, but they're more on the value side. In general, across all transactions, regardless of private equity or strategic buyers, what we're seeing is a major trend around the impact of market uncertainty. It's been, I think, less than 48 hours since we've announced, our friends from the South have announced another 50% tariff, even on CUSMA goods. It's constantly a changing and evolving market. We've seen this for the last, well, frankly, since 2020 with COVID. And in today's market, like a seller's expectation on value and price still remains strong, but the buyers, regardless of group, are still unsure of how to price risk. that's created by that uncertainty. And what that results in is a value gap, seller's expectations versus buyer's risk tolerance. And how does it get solved in a deal? Through negotiation, but most importantly, in terms of the deal structure. And when we talk about deal structure, we're talking about how the purchase price gets paid to you as the seller. So what I've done here is we've plotted the various different elements of transaction structure, how purchase price can be paid, and contrasted it between the two buyer groups. And these are generalities. If we're looking at cash, how much cash you're going to get on closing of a transaction, I want to preface this by saying that, like, regardless of buyer type, deals are not getting done with 100% cash on closing. That is very rare. It's the extent of the non-cash elements or cash deferral that differs between these buyers. I'll also point out that if a strategic acquirer, so the operating companies that are looking to buy, if they are public, they'll often use their public shares as a currency. So they might be paying cash on closing or issuing you liquid public stock. Vendor financing. So what this means is that it's a form of debt to the buyer. They're just not getting it from the bank. They're asking you as a seller to basically fund a portion of the transaction via over time. So the buyer's saying, look, I'll pay you X amount, but I'm going to do it in installments with some interest over typically a 1 to 3 year period. I put a line there meaning neutral. That's equally used depending on the circumstances between strategics and private equity, and it's really more common on smaller deals. Earnouts. So earnouts, I know they get a bit of a bad reputation, but we don't see them as a bad thing. Earnouts is basically tying future payment to growth that needs to be proven. And it's a way of bridging risk between the seller and the buyer. If you are a seller and you know that you're on a growth trajectory, maybe you've just invested new capital in your business, it hasn't really come to fruition, but you believe this is going to pay off in the next 1 to few years, and the purchaser is going to get the benefit of that. Perhaps you tie future purchase price or future payments to the achievement of those financial milestones. In doing so, as a buyer, you've managed risk because you don't pay unless that growth is realized. And as a seller, you're going to realize the benefit of it just over time. Rolled equity, this is, as I've mentioned, this is most common in private equity transactions because strategic companies, they want control. They want to buy 100%. And so what this means is you retain a minority stock in the investment or minority ownership in the company to incentivize you to continue to remain involved and grow. And then you can participate in future upsides. Lastly, we're seeing employment terms being used more to incentivize key management to stay on with performance-based compensation. Selling a business, we talked about the sales process, in the introduction. We look at selling a business as a series of phases, the prep and then the deal. And we could have an entire 1 hour seminar just on sales prep, and Natasha, maybe we should sometime in the future. But what I wanted to say is that, regardless of who you're selling to, the first stage is always planning. And our advice is build your company to sell it, even if you have no plans to, because there's no downside risk to being prepared and being able to respond to those calls that you might get from prospective purchasers when your phone rings. When should you start planning? Now. Another key message is the best time to prepare is when you don't need to sell. In general, we find owners really focus on the deal itself, but it tends to be a very reactive position. Through proper planning, you have more proactive, it's more proactive in being able to have opportunities to identify areas where you could create value or maximize value when you're ready to go into the deal process. In terms of the deal itself, this is a typical sales process that advisors will take you through. This is definitely a very clinical summary, and it really understates the complexity that goes into this process as well as the emotions. I can say for all the hundreds of deals that we have done, it is an emotional process. And as a seller, you're trying to sell your company, you also have to keep running it during the deal itself. What I would highlight here is the marketing phase. This is where you're going out to variety of purchasers to market your business. And to my previous point, you want to create competitive tension to drive up sales price. Having one buyer is almost the same as having no buyer because you can't create that competitive tension. So if we compare strategics to private equity in the sales process, the process is generally the same. What might differ is their attention to different parts of the process. Strategic are going to be very focused on fit, synergies, and culture, while private equity are going to be a bit more clinical, focused on quality of earnings, cash flows, and growth plans. So in terms of general timelines, we're seeing that deals are taking longer. On average, they used to be about 9 months from 2010 to 2020. Now we're seeing closer to just over 11 months. And why? It's risk. We're seeing longer due diligence timelines. Buyers, regardless of private equity or strategics, are taking longer to get comfortable and pressure test assumptions in order to understand all the different scenarios that might come out of this market uncertainty. And also, we're seeing more time spent up front looking at integration, transitioning systems, customers, culture, etc. Private equity might be able to expedite timelines just given they're in the business of deal making, but there's always exceptions, and we generally see timelines are pretty much the same. What will differ is your post-sale experience. As I mentioned, strategic buyers, they want to integrate your business into their existing operations. And so there's going to be a really defined transition plan, which basically offers you as a seller a quicker path to exit. The trade-off, though, is less autonomy and reduced legacy. Like often, culture and brand is going to be absorbed over time. Versus private equity, a part of this investment thesis is they want management to stay on and grow. And what this means is, yes, you're going to have future upside through a second payday of your rolled equity, but the trade-off is there's less cash up front and you need to stay on. So, I mean, overall, we'd say that there's no right buyer for a company. It really comes down to your personal goals. Private equity and strategics, hopefully you could see from this quick presentation that they have different objectives. So the best place to start is with the end game in mind. So first, at what point do you want to be fully exited from your business? Your post-sale experience is a choice, and it shouldn't be an afterthought. You want to think about, when you want to be fully exited, sitting on the beach somewhere. Do you want that to be clean, or do you want it to be over time? How do you want to get paid, and how much risk can you tolerate? Do you want immediate cash up front, or as much cash up front? Or do you want some liquidity right now and a second bite at the pie going forward? And lastly, what is the importance of your legacy, and what are you going to do with your proceeds after the sale? What is your number, and what is the best exit option to get you there? So that comes to the end of private equity versus strategics. Time just evaporated.
No, you're great.
So
You're great.
so much to cover, but I'll pass it over to Joanna now.
Thank you, Kira.
Thank you. And hello, everyone. I will get my slides up here. Okay, that should look good.
Yep, all good.
Awesome. So I'll, of course, go through the side of exiting your business from the employee ownership side of things. And just a quick, as Natasha and both Natasha and Kira has said, obviously, specific situations, are not covered here. This is pretty high level, general information. And I'm, kind of obligated to say that I'm not a lawyer or a tax expert. So as we go through this information, just to keep that in mind. I'll cover three sort of different structures for the purposes of today. That's how we've organized it, is the three structures we'll be talking about: ESOP, management buyout, and EOT, or employee ownership trust. For owners considering these options as alternative to what Kira had described, and basically just kind of giving a takeaway of simple framework to then, talk further with your advisor and help identify if this could be right for you. So starting off, I think it's maybe good to define when I say ESOP, what I'm actually talking about. So this is just broadly like employee share ownership plan, some kind of share transfer where in the end, the employees own shares personally. So that's what I mean by ESOP. That definition kind of, leaves it open in many ways for how exactly you could design that kind of structure. So when contrasting these different structures that we're talking about today, there are definitely a lot of similarities. The biggest takeaways here maybe is considering flexibility versus restriction. So on one side, you have a highly flexible structure in the ESOP. It can be broad-based in your employee group, or it can be very focused with certain individuals. You can transition as much or as little ownership depending on things like the company value, the owner's goals, interest from employees, and so on. And therefore, the owner has more flexibility to sort of exit on their timeline. Going to the management buyout, in the typical sense, it's a little less flexible. It's like right in the name, it's management buyout. So we're talking about typically for a small group of employees, involving them getting, external financing, either individually or somehow through the company, and putting their own cash in, and potentially some kind of sweat equity consideration. But that's a buyout type of transition. And on the complete other side of sort of this flexibility continuum I'm talking about is the employee ownership trust. It's on the other end really simply because it is a specific legislated program, so it has certain requirements, such as the requirement to sell a controlling interest to the trust, the eligibility. It has to be available to all employees. There's a certain time frame that you can create within that eligibility, but it's restricted to 12 months. And so ultimately, when you consider things like value of the company, if it's something that's out of reach for sort of your broad employee group, you might have that as a consideration to direct sort of which path you want to take. The owner's desire, to keep, what are the owner's goals, right? Desire to keep the legacy, the culture intact, and to transition and sell to the employees rather than a third party. Is that a primary motivation? And the EOT certainly on that side can be a very good option for many businesses. So the kind of structure of my slides, I'll go through, each section of the individual structures that I've just mentioned. Some of my slides I'll linger on a bit longer, and some not so much. So of course, the structures I'm talking about were across the board talking about internal sale, right? So the parties generally are kind of all internal, so to speak. But to be more specific, your ESOP, you're having the original owner, who's going to be the seller, and then you have the buyers. So these are individual employees who are buying shares directly, either using their own funds, using some kind of loan or program within the company that provides a loan, payroll deductions, or a bonus program. And then you have, of course, the corporation, the entity, the operating company. On the sort of other part of consideration around control and timeline and cash on exit and tax, I'll move to the next slide to touch on that a bit more. So with considering preparation, I think this is a part that, in contrast to your external type of sales that Kira was talking about, we can kind of look a little bit more focused in terms of like the process very close to making the decision and then going through your actual implementation and transaction. Whereas, on Kira's discussion was talking about a preparation phase of maybe a few months, maybe a few years. So we potentially have that here as well in employee ownership structures. But I guess one of the elements of the employee ownership kind of transition or sale is that you can be in a position where maybe the business does have room to improve and grow, and the ESOP can help facilitate that. And so you can go through that kind of preparation of improving the business, growing, and creating better value alongside with the ESOP. But at a base level, the owner would want to clarify their goals, understand, how broad are they going with this program? Is it a more key person focused plan? Is it broad-based for the whole company? And assessing the interest that's there. Of course, you can't just one day say, I'm selling you the company, and there's crickets and everyone's like, what do you mean? So having that preparation, of course, is a critical point. And looking at the valuation that you're going to be doing, what approach you're taking, which partner you're going to be working with. And so those things need to be taken into consideration really across the board of employee ownership structures. In terms of due diligence, what I'll kind of say is that, of course, you do have a number of different parties to the transaction, right? If you consider each individual employee to be an individual buyer, that could just on the face of it make it seem like, well, that's a lot of, like reviewing that needs to happen. And what we typically see is, because again, it is an internal kind of sale, you'll have sort of like a well laid out process will include some good education communication pieces to make sure that the employees as a group have the information they need. They can understand it. They have the opportunity to ask their questions, and a well laid out process is going to not have that kind of back and forth negotiation that you'd have in a typical like one-to-one or one to a couple kind of sale. So you have more of a friendly kind of internal process going on, but you'll still, due diligence wise, like the basics, you have the valuation, you have the financial review, and the legal side as well. Through the actual sale process, not necessarily one event in the case of an ESOP. This is where the flexibility comes in, right? So the owner, might decide that they're selling a minority amount over some period of time, or they might sell a majority amount over some period of time. So in the preparation stage, like I said, owner defining sort of their goals and their timeline is where this part gets driven from, and considering what the employees are able and interested in participating. The other note I have here is, I kind of touched on it a little bit, but going through like a well thought out, sort of very informational process to get through, very new information for most people, for most employees. This is a completely new kind of employment business structure that they're coming into. And so looking at it from that lens is just as important as getting through the technical components of the sale process, like the valuation and the drawing up of the legal documents. And then finally, after the sale, especially if it is a minority sale and it's going over time, the owner is staying involved for years. They often continue to maintain control until they're at that comfortable point where the management team has been able to take over. They've put in place good governance structure, and they're able to make that final transition. The ongoing kind of planned administration of it, because you do have usually these buy-ins, let's say over time, you are having transactions happen either annually or every few years, or again, flexibility. But so that means that there is that kind of administration to it, and making sure that you have in sort of your sale process and even in the preparation, well thought out mechanics of how that is all going to work. So moving into management buyout, again, we're looking at the owner, who would be the seller, the buyout group, which again are individual employees, just a smaller pool, and then the corporation. So here is, in a typical management buyout, how it would really be different from an ESOP is you're typically looking to say, like, hey, I'm selling my business. This is a transition of ownership. So control would go to the management group. But similarly, you'd want to start out with identifying the goals, identifying that leadership group, who they are, addressing their interest level, the financing gap, so understanding the valuation at this point, and what realistically that financing is going to look like. Again, there is a level of flexibility here in terms of them bringing their own cash, having some sort of sweat equity component to it, having even like some element of seller financing could be a piece, but a lot of the times it comes down to the bank and having either personally financing arrangements or something organized through the company. And like the ESOP, the due diligence, you have these people who are internal to the company who know the business already. And so likely it's not necessarily as intensive as sort of an external kind of sale and negotiation. But because you are dealing with typically a control position, you would have, that negotiation happening. You would have some level of due diligence and making sure that each party in the transaction has the representation they need and can get through the financial and the legal due diligence appropriately. I kind of already talked about sale process in terms of, the financing, typically where it is coming from, typically external. And you would go through kind of that normal private sale structure. The post-sale experience, though, the owner's involvement, again, in a typical sense, usually shorter, right? Because you have put your business in a place where the management team is already, has ownership over operations and is already running the business. maybe there's an ongoing kind of consulting period, but that's the plan, is that they are, handing over to the next generation to continue. And you have, again, an internal friendly sale that has happened. The administrative part of it is not as intensive if you only have it within a few key managers. And because it was, typically a single transaction, you don't have that ongoing sort of cap table and transaction administration that would happen within an ESOP. Okay. And then finally, the EOT, we're looking here at, an owner wanting to exit, wanting to keep the company with the employees, so wanting to transition the ownership that way rather than selling to an external buyer. They can sell to this trust, and so the trust becomes the buyer. So here that is, a key differentiation point, of course. Instead of the employees, it is the trust, and the employees become beneficiaries of that trust, but not actually direct share owners. Still, you would have the corporation as one of the key pieces of the transaction. One of the main differences on more of the technical side from a tax standpoint, and I'm sure most, if not all, on the call are aware of the $10 million capital gains tax exemption for sale to an EOT. Now, of course, there's requirements and caveats in the legislation around how to be eligible for that, but that was in a different webinar. So that's one of the differences in a tax standpoint. For the other kinds of sales that I've talked about, of course, it's your typical lifetime capital gains exemption, assuming the company and the shares qualify. So confirming initially if your company can be an EOT, if it can be eligible for the tax exemption, if the sale can be eligible, confirming what percentage to sell. Like I said, it is requiring a control amount to be sold to the trust, and then lining up your financing. The otherwise, like, it's fairly similar. There is full, due diligence that you would go through. And the employees are not the ones buying the shares, the trust is. And so typically you'd have, someone in that place of the buy side to review and understand the financials and the business and what they're looking at, and make that transaction. The post-sale experience then is potentially a bit different, given that you've had one transaction. Everything is in the trust, and so in some sense it's quite clean, and the employees then are simply beneficiaries. So the communication part and the education piece would come into play at that point. From the owner standpoint, typically what we're seeing is financed by a bank for a portion of the purchase price, and then they're providing a sort of vendor take back kind of note to get paid the rest of the purchase price over time from the company. I think that is pretty much all. I've mentioned, the difference in terms of the tax exemption. And then just to keep in mind some, I guess, key questions that you can ask yourself if you are thinking about any of these options. Thanks.
Thank you so much, Joanna and Kira. That was great. That was even better than I thought it would be. You all provided such great info. So I do have one question in the chat. I'll let folks add more or raise their hands as desire, but this one came in a few minutes ago. Um, in the US, some private equity firms have started granting some equity or at least profit sharing payments to rank and file employees of portfolio companies. Is this something that we're seeing sellers negotiate for during the sale process? In other words, do we observe prospective PE buyers trying to make their offer more attractive to a seller by offering to give employees equity or to make a payout to employees when they eventually exit in 5 to 7 years?
Yeah, I'll jump in there. I think I I would not say it's conventionally what we've been seeing on the deals that we've been executing lately, but that's I think it's very situation um specific. I know for one transaction or a couple transactions where we had um essentially three majority shareholders, but the entire management team of kind of like key producing management like actively in the business. They were all very small minority shareholders. So there was like 15 of them. They were all granted kind of as part of their new comp packages equity in the greater mothership. Um, and that was all like as a strategy to help align kind of activities, ensure kind of retention and growth. And that's because that investment was important that it kind of continue to run on its own. So I don't think I have one kind of blanket answer. I would say that sometimes, as terms of negotiating the deals between buyers and sellers, we're seeing just more conversation on kind of what employment packages look like and bonus packages look like for key employees. Maybe the buyer is actually, we've seen instances where the buyer asks the seller that as part of transaction proceeds that they get on exit, that they earmark essentially a certain pool of money to then distribute as bonuses and closing bonuses to that key management team, which is interesting. And again, to just ensure retention as the kind of key aspect there.
Yeah, something I sometimes have heard from business owners is a question of like, yeah, plans change in the future. What if our plans change and there is an acquirer and we're interested, but we already have an ESOP? Like, does that put in a barrier at all? And I think quite the opposite likely is that it's showing like you have a set in retention there already. And so for the potential acquirer, they could see that as a very big piece.
Yeah, thanks so much. That's great. Cameron was the next hand raised.
Hi there. Thanks for the presentation. That was very, very informative. Um, just a couple questions regarding the employee ownership trusts and after the sale. So does the employee ownership trust just function like any other inter vivos trust? And are there any limitations on who can be the trustee? Like, and I guess a subsequent question, like, is a trusteeship generally passed like a professional third party trustee, or is it a group of like, is it like shared amongst a group of employees or something like that?
Yeah, there is some legislation requirements in terms of who can be a trustee. So at a minimum, you have to have one employee beneficiary trustee. That at a minimum would meet the requirements of the legislation. Typically, I think what is going to end up coming out and as the more and more transactions happen is you'll see, an employee beneficiary trustee or a couple of them plus an external. So you can have an independent trustee to provide that professional sort of guidance and advisory part. And then potentially the seller also. So the seller can continue to participate in governance in that way as a trustee, but there are certain limitations that the legislation requires. And I think, Natasha, there is a webinar that goes into a bit more detail on that.
Okay,
Yes,
interesting.
we've had a couple this year, an EOT 101, which was in, I believe, February, and the recording is on our resources library. There's also a summary document from that if you prefer to read something. It's maybe 5 pages. And then we had a deep dive EOT Q&A last month, where if you're some really like some questions were answered that we heard from people that like they couldn't get answers to those questions anywhere else. So if you have really tricky questions, it's worth a peruse. If you're really thinking about it, it's worth perusing. There's the webinar, and also again, we have a summary document that's maybe 7 pages long that you can read over to see if anything is helpful. But there's a lot of content on our site on the EOT specifically, a lot of content.
Excellent. Thank you very much.
No problem. And I'll pass over to Jeff. That was the next hand up. That might be our last question. We'll see how quick it is.
Awesome, thanks. I'll try and make it quick. I have two questions, real fast. Can you explain to me, I guess this is for Joanna, just quickly define what a vendor take back note is and how it works? And I have a second question.
You want me to take that, John, or are you?
You could start, and then it just in the context of EOT, maybe.
Oh, I'll let you do it. I think he's talking about that. Okay.
Yeah, EOT for sure.
EOT. Okay. So what we're saying is like typically a bank would finance a portion of the purchase price, let's say like half the purchase price. The seller would just basically have a note then with the company saying the company still owes me this money for the shares that have already been transferred to the trust.
Gotcha. Okay. And what's I had a follow on to that, but I'll save it. The other question is I have two companies, both mature. One 13 years old software company. We have two software products. One entering pilot with a major corporation, and others behind that. The others still also out of MVP stage and into kind of a viable market stage. Both are niche. They're in the accessibility related sector. One on accessible procurement and small dollar procurement. The other on property assessment design. We're looking for some guidance, I guess, early guidance on what is the best exit for a company like that, considering we have an ESOP in place.
Okay. I guess, Kira, we're like, well, this might be more of a one-on-one, but
I think
Yeah.
this is more of a specific conversation. Happy
Okay.
to, yeah. If,
I would, and I'll just chime in. I would look at Jeff, I would look at our site on our resources library
Yeah.
for a bit more info on the EOT, a bit more info on employee share. Or we already have an ESOP, but a bit more on the EOT to get a feel for whether you think that might be that could work. And if it could, like reaching out to Joanna, that should be your next move. If you want to explore what Kira talked about, private equity, search funds, if you think those are, which I think, are definitely could be options as well, I would reach out directly to Kira on that. But there's a lot on our site, especially on the EOT. So it's worth,
Okay.
if you're really not sure about it or you don't know, it's really worth taking a look. And I'll just use this opportunity to plug our conference. So we have a conference in October. It's at the end of October, 21 to 23, I think, no, 20 to 22nd. It's in Vancouver. And if you're interested, if you feel like you're really interested in employee ownership, that is the best place to go because you will meet many companies that are employee owned, so you can learn a bit about what it's like. You can meet service providers who can help you with the transaction. You can, meet other firms that are thinking about it. It's a really great event. So I'm going to do that plug. So I think given that it's
Excellent. Thank you.
1:59, yeah, no, of course. We will stop there. The recording for this will be, thank you, Rachel. 20th to 22nd. I knew I got that wrong the first time. All the details are on our website. Again, our resources section, we just overhauled it. It's really easy to navigate, great place to get information. And yeah, this recording will be on our site probably in about a week. And we'll also have a takeaway document for this if you prefer a written format for the knowledge. So with that, I want to say thank you so much to Joanna and Kira. We are so grateful to have your brains in this room, this virtual room, to educate everyone. We are very fortunate here at Employee Ownership Canada to be able to put these on. So thank you, and thanks everyone for attending.
thanks.
And please fill out the survey. Thanks. Bye, everyone.
okay.